Hi, everyone. I'm Ivan Bayuki, and welcome back to Wall Street Silver. Our guest today is a very special guest, Mr. Joe Brown from the Heresy Financial YouTube channel. Joe, it's great to see you again.
Hey, thank you guys for having me on again.
Yeah, absolute pleasure.
So Joe, you're taking a pretty, I guess let's call it unconventional stance right now on the market. A lot of people out there are thinking the Fed's going to have to pivot eventually. You know, the economic data is going to get so bad from raising rates, quantitative tightening, that they're going to no choice. They're going to have to go back to easy money. But what's your position? You're thinking that's not the case.
Yeah. So this is something like there's no point to being a contrarian for contrarian's sake, but many times with things in investing, the consensus is going to be wrong. And this is something like housing is a good example. For the last 2 years, I've been saying houses are going to do nothing but go up, and everybody's screaming housing crisis, bubble, crash. And still to this day, prices are still going up. And so the Fed pivot is a good example of this, that right now, many people think that the Federal Reserve is going to have to pivot. We're seeing rates increase. We're seeing layoffs start to happen. We're seeing people get squeezed. Inflation is still going higher. We're seeing savings. Household savings is at an all-time low. Household debt is at an all-time high. So we're seeing these danger signs flash all across the economy. And everybody's saying it's just a matter of time until the Federal Reserve pivots, bails out the system again. We get a repeat of every single time over the last couple of decades what they've done. And my position, at least right now, is they're not going to bail us out this time. They're not going to pivot this time unless we get systemic risk. That's my caveat. Apart from systemic risk, they're not coming to save the day this time.
What would you define as systemic risk? Like no more bonds are being issued, the high yield bond market freezes up, something like that?
Maybe not even that, but the biggest players saying we're bankrupt, another Lehman type event. The federal government saying we're going to default, something. In Europe, all the banks start falling over, knocking each other over like dominoes. Global financial systemic risk is what I think they're drawing the line at. Apart from that, we've got a lot of pain to go before we get there, and they're not going to stop it until we do. And so the question that I always get is like, well, number one, people, when I've been talking about this for the last probably 2 months now, maybe 3 months. I've really changed my tune. This is something I've changed my mind on recently, that I thought, like everybody else, the bailout would come soon. And this is something I've been changing my mind on because it's different this time. The Federal Reserve has 2 mandates from Congress. One of them is stable prices. The other one is full employment. We've got job openings still, and that's how they're choosing to measure employment right now. And we do not have stable prices. 2% is not stable. That's how they define stable. We're nowhere near 2%. And so it's not like it was in 2020. It's not like it was in 2019. It's not like it was in 08, 09, 10. It's not like it was in the dot-com bubble bursting. We've got record high inflation all around the world, not just in America. And that's what's different this time, that if they don't get a handle on inflation, you get a hyperinflationary collapse of the currency. And the purchasing power of the dollar is the only thing. It's the foundation of the United States government's power. If the currency hyperinflates and the currency collapses, the United States government no longer has any power in the world. It loses its global reserve currency status. Nobody uses it for international trade. You can't pay your military to enforce your own laws, to enforce your global power. If people stop accepting the currency, it's game over. That's the end game scenario. And so they know that if it gets away from them, it's game over for them and everybody else. So they're saying, well, that's top priority. So as long as we still have high inflation, we're going to cause as much pain as necessary on anybody. Your 401k could go to zero. Your crypto can go to zero. Your store shelves can be empty. Your unemployment can go through the roof. The purchasing power of the dollar is number one priority right now.
That might be the case, but then I'm thinking, all right, we got an election coming up in November, right? And everything seems to change after a big election, especially if there's a huge change in power. And, if you look at the polls right now, Republicans are probably taking the House and the Senate by a huge number. Biden's very unpopular. He's catching a lot of the blame for this. What if there was and it's not that far away. What is it? It's already July. So we're only 5 months, 4 or 5 months away or 4 months away from an election.
Yeah.
So if the Republicans were to massively, let's say things keep getting worse for the next 4 months, we have a couple of more rate hikes between now and then. Things are really in the toilet by then, let's say economically. Unemployment's ticking higher. There's a change in power in Congress. I don't know, maybe that's sort of an endorsement for let's do something else, a different course of action. Would that change your mind?
I don't think so, because really politically what it comes down to is, are we going to continue to have a gridlock in spending, or are we going to have an increase in spending? And so when you look at the political gridlock preventing spending for the last year and a half, we're having government surpluses for the first time in decades because of this gridlock right now. And so right now, that's a deflationary force on the economy. It's sucking money out of circulation into the coffers of the government. If we get more political alignment and there's less gridlock, and it might not be spent on social welfare stuff, but it might be spent on other things, either way, it's a government transfer. So government spending by itself is not inflationary. It's a transfer. So either through taxes or borrowing, they're taking money from one area of the economy through taxes or borrowing and spending it into another area of the economy. The only time it turns inflationary is when the deficit is monetized by the Fed, when the Federal Reserve is buying that debt, because then the government's spending money into existence. Therefore, that is inflationary. It's not a transfer anymore. It's new money coming into existence into the government's hands, spending it out into the economy. So as long as the Federal Reserve maintains their resolve that they're saying that they're going to stick to right now, which is let assets bleed off the balance sheet and raise interest rates, doesn't matter what the federal government does in terms of spending. It's still going to result in the same thing, unless you get an insolvency issue with that the Federal Reserve then says, hey, this is systemic risk that we have to stop.
Well, but the Fed hasn't really been selling down. I mean, they said starting in June they'd be reducing the balance sheet, letting it run off. And then for June they really didn't do anything. I mean, they said it was going to be like 47.5 billion, and they didn't do any. They didn't live up to that. I mean, so they're already sort of not living up to what they've told the market they're going to do.
Yeah, part of that has to do with the way that mortgage-backed securities have a delay in the reporting and on the delay in this settlement. So unless they're just completely saying, hey, we're going to blow our credibility, they are letting assets bleed off of their balance sheet right now, and it is more of a passive bleed off because they have to replace a certain number as they bleed off. So you have a steady rundown, because if they just did nothing, it wouldn't be a steady rundown. You'd have big drops and then nothing happen. And so they do have to buy some to replace and then sell some as well, so that they get the steady decline. But mortgage-backed securities have up to a 3-month delay in when those settlement times are, and so they have a lag on when that actually shows up on the balance sheet. The other thing is they have other ways of easing if they needed to and wanted to without having to stop assets running off their balance sheet, like the reverse repo facility.
Okay, so assuming you're correct, and that's where we're headed, more tightening, I guess a few more rate hikes coming down the pipeline in the next few months, and gradually selling off the balance sheet of the Fed. How does that affect asset prices? The housing market, the stock market, gold and silver prices. How does that affect everything?
Yeah, it always comes down to supply and demand, right? So you're still going to have things that go up in price, even though money's getting sucked out of the system, just because there's virtually no supply. And that can change on a dime, right? But that's always what it is. And so when you look at something that is that the supply has a large stockpile, something like gold, that the supply of gold really is very little impacted by new gold coming onto the market. It's like 0.5%, 1% of all existing gold inflation rate is mined every year and produced and put onto the market. So the supply of gold is just the existing supply that's always existed for, you know, all of humanity, and similar with silver, although less so. And so when you have something, when you look at the supply and demand dynamics of something that's durable like gold and silver, the money supply, monetary policy has a huge impact on that, because the demand for it will be dictated by the available money in the system to demand for it versus everything else. And so when the money supply starts to shrink, then you still have the same amount of goods and services. And so you need less money to get the same amount of goods and services. Another way of saying that is that things get cheaper. So that's very true of something like gold and silver, that as money gets pulled out of the system, there's less money available to buy that gold and silver. Therefore, the price adjusts downwards. But at the same time, especially for gold, it is very forward looking. It factors in and anticipates future monetary policy. So the uglier things get, the higher and higher chances we have of that Fed pivot at some point, because if things get really ugly, you know, the printing could go through the roof. So gold starts to anticipate that. That's why at the beginning of 2020, gold went up 40%. Guess how much inflation there was when gold ran up 40% in those few months?
Yeah, they did. The inflation came much later. Yeah.
Right, exactly.
Gold anticipated the inflation that came later.
Right. And so the same thing would happen again, that once we see, all right, the tightening is done, that's going to be the floor. That's going to be the end of the pain. And so I do think we have a lot more pain to go. I don't know how much lower gold and silver can go. But until there's some sort of
much lower than we thought. No one's real happy right now in the gold and silver market, not after today.
Yeah.
But you know, I guess that's a good point to make, in that the market does anticipate, or the markets anticipate these things well before I think anyone else does. The smart money starts sniffing it out before the dumb money, and I guess we're dumb money because we've been wrong. But I just can't help but think that politically they're not going to have the stomach to really handle the pain, because what they did, once we're officially in a recession, which probably is next month, right? As soon as the second quarter numbers come out, we'll have 2 quarters of negative growth, official recession. Congress, and it'll be bipartisan, Congress is probably going to start authorizing expanded unemployment benefits, expanded food stamps, expanded whatever, all the usual programs they do when there's a recession. And that becomes more fiscal stimulus. And who's buying those bonds these days? No one really. I mean, the Chinese are not buying extra bonds. They're gradually running off their bond portfolio. Japan's not buying right now. Europe's not buying right now. And supposedly the Fed's not buying. So, you know,
this is great.
If we start spending for all these extra government and maybe a new round of stimmy checks, right? You know, $1,200 for everyone. And that seems to be the latest playbook they have. If all these spending programs come down the pipeline, what is that? Another 2 trillion, 3 trillion? Because there's going to be bailouts for everyone else too, all the states.
Yes, this is okay. Absolutely perfect, because a couple things are going on here. Number one, at the beginning, none of that is inflationary on an aggregate level. If you have all of the stimulus programs ramp back up again, but the Fed does nothing, this is just government now that we're talking about. This is fiscal policy, not monetary policy. So they start giving out $1,000 UBI checks. They start giving out gas rebates. They start giving out food subsidies and anything they want to do, right? Those are transfer payments, because it's not being monetized by new money. So that money is coming from one of 2 places only: taxes or borrowing. And so if it's coming from taxes, it's the middle class and the wealthy that are funding those transfer payments. If there is a deficit, so it's not coming from taxes because it's in excess of taxes, so there's a deficit, then it's coming from borrowing. And so if they're borrowing more and more and more, but the Fed is not monetizing it, that means rates will go higher and higher and higher, right? So The question is, how long can that continue? And the answer is it can continue for years, actually, because when the government starts spending more money, borrowing more money at higher interest rates, that only affects a very small amount of their total expenses. It's not until all that old debt starts to mature and they roll over that old debt. So if interest rates hit, let's say, on the 30 year, let's say interest rates hit 6%, it could be 3 or 4 years before it gets to the point where their total interest expenses are a problem for them given their income. And so that's the first thing, is that these are all transfers of spending. It's not inflationary. It'll get to the point where the government can't afford it at some point, but that can last for a long time. In the meantime, let's say they want to spend another $2 trillion. There's $2 trillion in the reverse repo facility right now. And so if the Federal Reserve looks at systemic risk and says, hey, interest rates go up too high, we're going to start seeing things fall over. We're going to see, a mass collapse of everything. All they have to do is take the reverse repo facility award rate down to 0 or 0.05 or 0.25 or whatever. The reverse repo facility money, $2 trillion, will drain out. It'll go buy short-term government debt and provide $2 trillion worth of stimulus and effectively be a way to fund another $2 trillion of government spending. So that's a secret weapon that's still locked and loaded, dry powder, ready to go. At the same time, the Federal Reserve doesn't have to raise the interest rates, and they don't have to stop selling assets. They can continue to do that, look like they're tightening while they're shoving $2 trillion out the back door from banks and provide some stimulus that way. And then at the end of the day, if it's still not enough, if the government's still going to default and the $2 trillion has already been pushed out, all the Federal Reserve has to do is start up QE again, just for government debt, not even mortgage-backed securities, and only bail out the government, and then let fiscal policy do what it's going to do and fund the government and let everybody else go bankrupt. And they can still do that. And they will, if it means trying to fight high inflation still.
Gosh, this sounds complicated. I wasn't
depressing.
I just want a scenario where gold goes to 3,000 and silver goes to 50. Can I just have that simple scenario, please? I don't need all this.
Yes. Yeah. I would like that too. And I think it'll happen. I just think it's going to take a lot longer than a lot of us initially expected, given how they've handled crises in the past. The difference this time is high inflation. And they admitted the other day, they said, we now understand how little we understand about inflation. And they're so backwards looking that by the time
he got a lot of criticism for that, didn't he? He got ripped over.
Yeah, I mean, it deserves it.
It's a crazy statement for the Fed chairman to make, wasn't it?
Yeah.
But, Joe, you've made your call. You've documented it. It's going to be on the YouTube forever.
Right.
Don't worry. If you're wrong, turns out you're wrong, I'll delete this video off of YouTube. So no one will ever know you said this. Okay.
Right. Now we'll do a follow-up, because like I said, I changed my mind before about this. And if something else happens, when the data changes and the facts change, then I'm going to obviously change my mind. I'm not going to beat the same drum for the rest of my life just for no reason.
All right. Well, thanks for joining us and giving us your point of view. We really appreciate it. And let's talk to you again we'll follow up in 3 months and find out whether or not you were right.
Sounds good. Well, thanks again for having me on.